But I think perhaps a little more downside, and stock has done very well recently, trades at pretty high valuations now. Your thoughts?
So Prashant, again, like the markets, looks like this stock is also giving a pullback. At the lower end, I think 1300 or maybe, in worst case scenario, 1250. So I think around those levels, you will see the stock stabilize and then should give a reversal. So around 1250, if I can get it and see any kind of a minor reversal pattern also, I would want to take a long trade.
We starting with a 70-point cut, Mitesh.
On
Anything to do
Voltas,
right
right?
away? No, on the Nifty, beg your pardon. A 70-point cut.
Yeah.
So about,
So-
what, 22,200 or so. Anything to do there?
So in fact, 22,200, 22,180 is my buying zone. So in case we start over there, maybe we'll take a small trade, and in case there's more reversal, we'll add to the down.
Right. Got that. Well, let's just see. We got the rates coming up on your screen. 60 points lower on the Nifty. So 22,240 is where the Nifty is at. The Sensex is down about 180 points. 73,340 coming through on the Sensex. You've got market breadth on your screen is exactly 1:1. So things are just opening up. Bank Nifty is down about 0.3%. 48,150. And you've got the mid-cap index, which is down about 0.25%. The small-cap index will also come up on your screen. And there also, I think there is a bit of a cut. By the way, the small-cap index in the last 2 sessions alone has lost almost about 4% or so. So there is more of a pullback there in that part of the market as compared to what the Nifty is seeing. So that's it. 80 points down now. 22,200, exactly in that zone that Mitesh was talking about. 22,166, by the way. Just a little lower from here is that 61.8% retracement of the rise. But stocks is what it's all about. Sonia's got those. Sonia.
Well, thanks a lot for that. As you rightly pointed out, not a good opening at all. In fact, now the Nifty is inching towards almost a 100-point cut. So that's not, good to see at all. The Nifty Bank is the one that's, seeing some pressure, so down about 150 odd points. But let's take it straight to individual stocks. You have Dr. Reddy's, where the numbers were decent, actually adjusted for one-offs. The India business was up about 11%, but the overall numbers didn't look that good, so the stock is down about 5% odd. Pidilite saw a good set of numbers, volume growth of 12.7% in the consumer business. United Breweries, decent earnings, a volume growth of 10.9%, but the market mood is such that most of these stocks are going through some profit taking. Voltas was very disappointing this time. The stock is down almost about 8% odd. Operational pressure continues. Losses from the EMP business remain elevated. PB Fintech is another one that is, it should be in focus. The stock is down about 5%, but the company's earnings were quite strong, actually, aided by the core online performance and a revenue growth of 25%. The company has, in fact, turned profitable on the bottom line, so keep an eye out on that. Max Financial's earnings also, were quite good, and that's why the stock is actually bucking the trend today. Both UBS and CLSA have a buy. In fact, CLSA has a target price of 1,400 on Max Financial, so a big upside over there is what they expect. REC also in focus after the conference call details that came through. The stock is seeing a bit of a recovery, but otherwise it's not a good opening for the market at all. 100 points lower now on the Nifty, just hanging on to that 22,150 mark. Back to you.
All right, Sonia, thanks a lot for that. Well, a few stocks that are moving around. Dixon, the stock has opened up in the green. They've announced that its subsidiary Dixon Electro Appliances has entered into an agreement with Nokia Solutions and Networks for manufacturing telecom products. So that stock, in fact, opened up in the green with a gain of 2%. It's come off a little bit. Some result reactions, actually, and some of these stocks are taking it on the chin. You have Suraj Estates that's down close to 5%. The stock saw a one-way rally, in the last few sessions. It went to a low of around 260, went to around 420 odd, but now that stock is down close to around 8%. So slam dunk on that one after the big rally that we've seen. Sonata Software, that's the other one that's down more than 10% in today's trading session. The dollar revenues on the services vertical is down 2.5%, and the margins have got compressed to around 21% from around 24%. So margin compression, revenue decline on a sequential basis, the street doesn't like, so that's why that stock in fact is lower. And Jupiter Wagons, we'll chat with the management in just a bit, but for the time being, that stock's opened up well in the green as we speak. A bit of a bounce is what we're seeing from lower levels. Voltas is the casualty of the morning, losing market share. The street doesn't like that. United Breweries, good top-line growth, good focus on premiumization, margins disappointing. The stock was down 3% odd. It's cut some of its losses. Now it's down 1.5%. On the index, a quick word out there. If you wanted to enter into the index, you'd be hoping for a level closer to around 22,200 odd. You got that in the first few minutes of trade. So if you're adventurous, then maybe, in fact, if you're playing for a bit of a bounce, this is the crucial zone. 22,160 to around 22,200. You can hold these levels. There's still some kind of hope for a bit of a bounce. Keep an eye out on Vodafone Idea as well. More than 20 crore shares getting exchanged in the first few minutes itself. So that one should be on your radar. Prashant.
I think, we got a couple of calls on Vodafone Idea, right, recently. I think Citi has put out a call this morning. Earlier, I think we had, was it Bank of America? One of the foreign brokers, basically, they had a call out as well. All small upgrades from wherever they were, on the stock. Nothing large in terms of target price, etc. But a bit of improvement there after, of course, with the fund infusion, etc. Has happened. So there is, of course, a lot which is going on. Maybe if you can just quickly pull up Voltas for a quick bit and see if there is a sort of price action coming up. It's down 9%. And we were talking about this with Mitesh in the morning just now. So that's coming up to a crucial level there as well. So 1264. And by the way, this after the 5% cut that we saw yesterday. And that's a large liquid F&O name that we are talking about. So it's a mostly down kind of a day so far. We'll pick up more stocks, etc. as we go along. But let's welcome in our market master, Tahir Badshah, CIO, Invesco Mutual Fund. Tahir, good to have you with us here. Thanks very much. Good morning. What's worrying the market at the margin, Tahir?
Well, so as expected, actually, Prashant, we are walking into that phase of higher volatility, and probably, after a long time, we are going to see multiple events which are going to be lined up over the next 4 to 6 months, and all of them in one way or the other probably are important, whether it be in the form of local elections or whether it be policy thereafter, monsoons, US elections to contend with, and of course, we are still not settled as far as the interest rate inflation debate is concerned, and that probably also will be important towards the end of the year. So I think we are clearly going to be in a phase of somewhat higher volatility, and probably markets will be a little more defensive in its approach.
Markets will be a little defensive in its approach. Got it. Tahir, hi, good morning. I think there are election jitters on everyone's mind, right? People perhaps believe that maybe the incumbent government may not be able to get the kind of seats that perhaps they were expecting to. At least that is the fear in the market right now. How legitimate do you think that fear is? And if it does play out in that sense, where the number of seats don't hit 400 as perhaps is the expectation, then do you see a big market fall? If that market fall happens, would you suggest buying into it? I mean, what do you see the trajectory to be for the next couple of months?
Yeah, so like I said, I'm no political expert, but obviously in the mind of the market, there has been an elevated expectation. And I think irrespective of whatever the outcome would have been, probably I would have thought that there would have been a correction, whether it would have been a sell on news or probably some kind of disappointment in terms of the outcome for the incumbent government. So I think both ways there was, going to be a correction in my view. But I think, the market, Sonia, is very strongly focused on an expectation of 15% compounded earnings over the next 2 years at the broad corporate level, large caps within which might do probably somewhere between 11 and 13%, and mid and small caps probably might track something between 16 and 20. And you get a blended 15. So I think for the market as such, I think it'll be important to see whether there are factors which can detract from this 15% number. So long as that visibility of that 15% is by and large visible or available, I think to that extent the market should probably hold up. You will probably see corrections along the way, modest ones which come as a result of one or two of these events probably not going the way we expected to. But for deeper cuts to happen in the market, I think market has to kind of reconcile to the fact that that 15% number is at risk. And that will take multitude of factors to probably happen.
All right, I just hold on to that thought. We have a con call that's underway on REC, and they're commenting on RBI's project finance draft. They're saying that RBI's draft guidelines not applicable to loans guaranteed by the government. They also go on to say that many of their loans are supported by state government guarantees. And there's one more flash that should come up for you on the screen. They say they're not going to see any adverse impact due to RBI's draft paper with regard to project financing. Explains why the stock has seen a bit of a bounce. Last few sessions it's taken a knock. I think DAM Capital is hosting that call with the REC management. For the time being, the stock has seen a good bounce on this commentary that's coming in on that con call. Abhishek will join us shortly as well to run us through an impact on this. But for the time being, a bit of a relief rally is what we are seeing. Well, hi, Tahir. Good morning and good to see you. Well, let's keep elections aside. How are you positioned on FMCG stocks? Out of nowhere, you saw some positive commentary coming in there. And now the street is coming to terms that maybe FY25 is not going to be as bad as earlier thought. Also, there's a bit of an under-ownership that's playing out in some of these stocks. Your view and how are you all placed out there?
So Nigel, we not necessarily only FMCG, but by and large, I think we generally our approach is to kind of try and keep a little bit of balance as far as the portfolios are concerned. Even in, for example, even in very strongly growth-oriented strategies, we do have a smattering of value in our portfolios. And I think I would have spoken earlier, even on the show, that probably there is value in some of these value consumption pockets, which have not probably done well in the course of the last 2.5 years, given what's been happening to the lower end of the income pyramid as well as in the rural markets. We are seeing, obviously, there being some triggers not fully established, but some reasons to probably try and expect an uptick as far as volume growth and a recovery in that segment is concerned. So I think we have been taking some modest positions out there. Like as I said, we don't have full evidence, so we don't have a choice but to kind of wait for some more evidence to come through in the form of numbers, quarterly performance, volume growth, etc. But clearly, I mean, there is an initial case to have some foot in the door as far as some of these segments are concerned, which have turned value in the course of the last 2 years.
Okay. I wanted your thoughts on some of these consumption pockets, which are big beneficiaries of, say, premiumization, right? We've seen them in the auto space with names like M&M. We've seen them in the alcohol beverage space with names like Radico, Khaitan, etc., United Breweries. In real estate, a lot of premium projects are selling now. Do you think this premiumization theme is something that can continue? And if yes, which are the pockets where you still see some valuation headroom here?
So unfortunately, on your second question, there's pretty much no valuation headroom which is available out here. But the point is that this is still a reasonably structural theme, and I think this is something which has probably got a little more credibility to it, probably compared to, as things stand at least today, compared to, let's say, the revival at the lower end of the market. I mean, if on a 2-3 year scale, I think it is a lot more easier to expect that premiumization and growth in those particular segments, whether it be retail or whether it be in automobiles or a few other sectors, is far more easier to expect and reconcile with. On the lower end of the income segment and particularly rural revival, it will take a fair bit of effort, not just only monsoons, but probably even in terms of policy and a few other things to actually come together for that recovery to kind of take legs. So I think premiumization as a story continues in my view. Of course, they are not probably, I mean, you may not have valuations which are on your side of the stage, but if you were to probably get some of those corrections, which are quite likely from a rotational perspective, I think those are themes which may still excite us.
Right. Tahir, we just heard that comment from REC, right? Financiers, really, what's your view? Do you own some of these names, especially on the power financing side?
Yes, a fair bit. I mean, we have been owners with, some of these stocks have done exceedingly well. So, over the last 1 year or so, I think most of the investors who have come in at various stages would have probably made some kind of money or the other. But obviously, we've seen the regulator being very vigilant about every pocket, and it was initially supposed to be only on the personal loans and on the consumer loans segment.
Tahir, how would you read the comment from that con call? I mean, if I can ask you that, since you have exposure, so you'd kind of know. They're saying that government guaranteed loans, that one flash which came, the standard asset provisioning going up to 5%, it doesn't apply to government guaranteed loans. Basically, there was another general comment saying that there won't be that much of an impact. We had Nikhil from Bernstein earlier, the analyst, who said, this perhaps means that if you sort of work it back and look at interest rates and how much they need to go up by to compensate for this increase in provisioning, it's about 30 basis points, basically. Just your thoughts, Tahir.
So I think it probably, at least from the comments, it appears to be a little less, punitive compared to what was feared initially. To that extent, it may not be as harmful. But the thing is that, it just at some level the market will now keep this in the back of its mind that there would always be some regulatory pressures which will come along the way, especially if some of these segments continue to show very strong growth. So I think may not necessarily impact as much in terms of book value compounding or probably growth in earnings, but clearly there will be some capping of upside as far as valuations is concerned. That's the easiest conclusion that we can probably make at this stage.
Yeah, no, absolutely got that. So, I mean, there's one view that you look at all of these regulations, etc., from the RBI, and maybe they just want, the credit growth to maybe come off a little bit, right? It's been running red hot in some segments, especially, and not exactly a bad thing. On the capital market side, Tahir, are you worried that we may eventually see some regulations, etc.? Because we've heard a worry being expressed by the regulator on that side, on the futures and options side, and that has really been a big driver for growth. Just wanted your thoughts. We had a fund manager earlier, 2 days back, who was pointing that out, that that remains a big risk for some of these stocks.
So, Prashant, it remains an outside risk, and that's something which we keep in mind, at least in terms of the way we size our position in some of these names as far as our portfolios is concerned. We still are reasonably confident about the growth trajectory of some of these enterprises, and that at least is supportive as far as those capital market stories are concerned. But we can't take away the fact that this is an outside possibility. However, some of the recent moves by the regulator probably don't seem to suggest that they want to go all the way down to really taking a very hard call on curbing volumes, etc. So it's that's where it is. I mean, this can obviously change. That position can change tomorrow. But at least from some of the recent regulatory changes, doesn't seem to suggest that they want to go all the way down.
Okay, we leave it at that, Tahir. Thanks a lot for joining in. Appreciate your time here. By the way, the market is not bad. It's down, but not out. The Nifty is down about 76 odd points. The Bank Nifty is down about 200 odd points. And the big damage really has come into Dr. Reddy's this morning, down 4%. L&T is down 1.5%. HUL is down about 1%. Hero MotoCorp ahead of its earnings is down about 0.6%. So just keep an eye out on that. But we have Tata Communications Q4 earnings, which were a bit subdued. Their margins contracted, the EBITDA declined, while the revenue growth was in low single digit. The management reiterated their ambition of doubling data revenue by FY27 and getting back to 23 to 25% EBITDA margins in the medium term. Amur S. Lakshminarayanan, who's the MD and CEO of the company, joins us now. Sir, thank you so much for joining in. I want to start by asking you about the reason behind the weaker data revenue growth. This, data business was your main growth driver for the last many years. So why are you seeing this kind of slowdown? And what kind of growth trajectory do you expect? Because, given that there is a bit of a slowdown, do you think that a 15 to 20% growth is possible?
I want to emphasize the fact that if you look at the overall data grew by 20%.
Mr. Lakshminarayanan, we can't hear you very well. Okay, can we try one more time?
Yeah. Can you hear me now?
Actually, we're having a bit of an issue with your audio. So what I'll do is I'll come back to you in a bit. We'll just try and fix that audio. It's a bit scratchy there. Just wanted to mention a couple of stocks that are bucking the trend at the moment. You have Maruti, which is up almost about 0.7%. SBI is up almost about 0.5%. And Reliance is batting for the bulls this morning. So just keep an eye out on that. By the way, the mid-cap index is now trending, almost moving into the green. There are some stocks which are not doing too badly. IGL is up about 5%. PFC is back in the green in a big way, up about 4% or so. IRB Infra, REC, these are stocks that are up well in the green. So yes, the mid-cap index is now trending in the green. The advanced decline ratio is also pretty good today. So today is not such a bad outcome. Given what we've had in the last couple of days, today is not such a bad outcome for sure. I think we are back with Mr. Lakshminarayanan. Sir, you were telling me about, your data revenue business, right? It has seen a bit of a slowdown. So in terms of a timeline, when do you see it recovering? And is this 15 to 20% growth possible for FY25?
Yeah, I was just mentioning, if you look at the overall year, the data revenues grew by 22% last year. While we saw some deceleration, over the quarters, but overall for the year, the data revenues grew by 22%. Last year was a phenomenal year for us, having invested in a lot of organic products and platform investments that we made. We also acquired 2 companies, and we are busy in the process of integrating them, both the switch in the media side of the business, as well as on the interaction fabric, the Kalera acquisition that we did. So we feel quite confident about the portfolio of the network fabric, the interaction fabric, the cloud and security fabric, and the IoT fabric. The IoT fabric last year did not grow as much as they did the previous year, but all the other fabrics grew very well. So going into this year, barring the cautiousness that we see in the international markets, we are quite confident that we will be even more relevant for our customers and participate in deals with very large customers.
So can you tell me a little bit about the order booking? You've just said that it was weaker than expected, but can you just quantify it for us? How much weaker, and when do you think the recovery can come through on order booking?
Order booking is slow. I mean, it's very hard to predict. I just came back from a trip meeting customers. The very encouraging thing for us is we are able to participate in much larger conversations than before. And that gives us the confidence that as and when it opens up, we will be able to participate. And of course, we need to win those deals. But our participation levels are increasing. Our investments in the markets to increase our coverage is helping us. But closure is slower. While we don't call out the ACV numbers, partly because in this business, the ACV numbers are a bit difficult to quantify. There is fixed contracts in the network business, but also increasingly more usage business that comes. So you might sign a contract, but the usage has to ramp up. So the ACV numbers don't really directly relate to the revenues as lead indicators. But as and when the situation improves, the closure should increase. Another point I would like to point out is our next-gen connectivity last year grew upwards of 30%. So there are, the next-gen connectivity has organically grown very well. The interaction fabric grew very well, organically somewhat muted, but because of the Kalera acquisition, we showed very good growth. And similarly, the media business organically grew in double digits. Of course, with the switch added on, we showed much better growth as well. So the focus for us going forward is going to be integrating all of these acquisitions, participate in the market a lot more aggressively, and drive growth.
Got it, sir.
Yeah.
I got it. Mr. Lakshminarayan, good morning. Prashant here. Just to sort of dial back and get that number from you if possible, sir, on the revenue front. Would it be between 15 and 20% in FY25?
No, see, we don't give any quarterly and yearly guidance, Prashant. You know that.
Is it in the ballpark or is it wildly off?
No, it's not fair for me to give any guidance at all. So all I would say is, when we said that we wanted to double our revenues, the expectations that we have internally is that we would be growing at the
data revenue doubling that you talked about, that's still on track by FY27.
Well, our ambitions are very much in track. The investments that we are making is towards that. Last year, of course, aided by inorganic, we grew 22%. So going forward, we need to keep up the momentum, combining the entities that we've integrated organically to deliver the kind of growth between 15 to 20% is what we would expect to do. And that is what we are working towards. So the encouraging thing that I would again point out is the relevance that we have, the ability to participate in much larger deals with customers have only increased because of all the investments that we have made. Okay,
all right. Hi, good morning, Mr. Lakshminarayan, and thanks a lot for joining in. So you've given us fair color on the revenue growth trajectory. What about margins? In the last few years, margins have come down to around 20% odd, but you're guiding for some kind of recovery in FY25. Could you tell us what are the triggers and how much could it recover? And also by FY27, should we assume you get to that band of 23 to 25% that you've been guiding for?
Yes, I know, absolutely. I think I clarified on the margin side. So I would like to split, if you split the business by the core business, taking away the investments that we made on acquisitions and acquisition-related costs, the margin still would be in the ballpark of the 23%, right? The second factor that we called out are some of the subsidiaries were a drag on the margins, and we said we were going to do a strategic review of the subsidiaries in order to improve the margins. And the third lever we have is all the digital businesses which were of intrinsically of a lower margin so far would organically start delivering more margin because of the operating leverage. So these are the levers that we have that we will operate in the coming year and the next 2 years to get it back to the 23 to 25%.
Okay, all right. And in the near term, for FY25, what should we work with? Because the margins actually breached 20% on the downside in Q4. So if you could quantify it to some extent, we got it. In the next 2 to 3 years, you get to 23 to 25%. But in the near term, what is it? And also wanted to ask you about your net debt to EBITDA. That stood at around 2.16. But you've said that it's likely to come down to sub 2. Does it happen in the first half of the fiscal? So give us some color on margins as well as net debt to EBITDA number.
Yeah. So again, I don't want to give anything on a quarterly basis and a short term in FY25. We will see an increasing trajectory of the margins because it has to get back to 23% in the next couple of years. And I talked about all the levers that we are operating. I think the foremost focus for us is integrating the acquisitions that we did and drive the synergies both on the revenue side and on the cost side. So that's one of the major levers that we would be operating on. And we are quite hopeful of improving the margins. And as we improve the margins, the cash conversion for us has been very good. And we will be able to pare down the debt as well. And we have to remember, we are in a business where the portfolios have significantly transformed, right? From the nature of the business that we were. Our digital business now are approaching 50%. That was one of the goals that we laid out in our strategy in 2020. And for transforming the portfolio, we need to make a lot of investments on products, platforms, people, capabilities. And without those investments, the growth would not come. So I think those are the phases we are in making those investments. And we are quite certain and hopeful that the
But the net debt to EBITDA, Mr. Lakshminarayan, sorry, we need to just try to get that number out for you. Net debt to EBITDA, you said it comes down to 2. It happens in the first half of the fiscal?
Again, I said I don't want to give anything on the quarterly or a half-yearly basis. That is not what I do. I will lay out my plans for the medium term, and I reiterate the numbers that we are aiming for.
Sure. Mr. Lakshminarayanan, since you're not giving us numbers, can you at least tell us what the trajectory is in terms of, decision-making by clients? Are the orders getting deferred? Are they getting delayed? Do you fear that there could be some large orders getting deferred or maybe even getting cancelled as well? Just trying to understand what the trend could be over the next couple of months.
Yeah. No, I think the orders are and were getting delayed. The funnel, we are continuing to improve the funnel by adding more into the funnel. In the network, particularly in the network business, not so much in the interaction business where switching vendors or adding new vendors is relatively easy. In the network, in the international markets where we win larger deals, it's largely, they replace the incumbents with us. In those kind of situations, it's like touching the live wire. So they are a bit conservative, and with uncertainty around their own organization and changes that they have seen, there is some reticence to change, is what we've been observing. But we are, as the funnel improves, we think that our conversion would also begin to improve.
That margin bit, since it's a couple of years out, Mr. Lakshminarayan, maybe let me try and ask you to request you to fine tune it if you can. Since it is 20 and getting to 23 is going to be a big improvement. And of course, getting to near to 25 is going to be even better. But would you want to fine tune it a little bit, closer to 23? I mean, we know the range, but
You mean in 2 years' time?
Yes.
Yeah, no, in 2 years' time, we'll definitely be in 23. Whether we cross 23 is a question that we have to ask ourselves.
Okay, so I mean, if you wanted to go with one number, that'll be, I mean, 23 in 2 years' time. That's the target. All right, got that. Thank you very much, Mr. Lakshminarayan. Great to have you with us here. Thank you for your time. Appreciate it very much. Those comments here on CNBC TV18. I mean, I think the market's seen a nice, decent pullback. You know, it almost got to that that retracement that we were talking about. The day's low, by the way, in the Nifty is 22,185. 22,166 is that level that we were talking about in the morning. So you almost got that. And then there is a bit of a pullback. It's turned green. The candle has turned green, which means you're basically trading above the opening levels. We'll take a break. We're back. Vivek Lohia, Managing Director, Jupiter Wagons, will be joining in to talk about their fourth quarter and full year performance. And of course, we'll ask them to look into FY25 as well. Stay tuned.
Well, the stock of the moment is REC, and it's having a rub-off on PFC as well. There was a con call that was just hosted. Abhishek joins us to run us through all those key takeaways. Abhishek.
To start with, REC management has given a guidance with respect to roadmap ahead. So they expect AUM to double by 2030 to about $125 billion from the current level of about $63 billion. And they can also do it by 2029 is what the management did say in the con call. They'll increase the renewable energy portfolio to 30% from 7% of the AUM that they have currently. Renewable energy portfolio can increase by 10 times by 2030. Lot of disbursement will happen in renewable energy portfolio. Distribution sector will also provide good opportunity for them to do business over the next 10 to 12 years. Now, the key highlight is the clarification that they have given with respect to RBI's draft guidelines on project financing. So they say that it's only a draft guideline by RBI. REC is an NBFC and follows IND-AS with respect to accounting standards. So as per RBI asset qualification account, next 3 years. Now, RBI guidelines are not applicable to loans which are guaranteed by government. And I was just taking a look at the loan breakup. About 89 to 90% of their AUM is by state government. So this will impact only in the generation segment for them. RBI rule will not impact adversely with respect to REC is what they mentioned in the con call. Back to you.
Okay, thanks a lot for that, Abhishek. Clearly, the street taking note of those comments, and the stock now at the high point of the day. REC and PFC, both of them moving to the high point of the day. Let's focus on another company, though, Jupiter Wagons. Well, they delivered a good set of numbers. So the stock started off well in the green. I think as we speak as well, it's holding mildly in the green with a gain of around 1%. Last year was good. What's the way ahead? Mr. Vivek Lohia, the MD of the company, joins us on the show. Hi, sir. Good morning, and thanks a lot for joining in, Vivek.
Here we are on an expansion mode and we are increasing capacity. So this in the coming financial year also you will see a substantial growth in revenue. Further, we are adding new products. Last year there was no impact of the braking business. This year you will see a sizable impact on that business. On the wagon side, the momentum continues. We are get into procurement mode. So you will see much more tenders coming out from railways. Recently, I think going forward, our focus is definitely on our wheel set business. Recently, we acquired the Bonatrans India business. Now, going forward, our idea is to definitely establish it we are looking at doing sizable backward integration there. Where
Vivek, let's take it piece by piece. That inorganic growth as well we want to talk about. Just for the last year, you did around 3,600 crores. Margins of around 13.5%. So let's take that out of the way first. You're expecting orders to come back post the elections. But what kind of revenue growth can you guide us, given the kind of acquisitions you have done? There's ramping up of capacities as well. So you did a big growth on a lower base. On 3,600 growth, margins, order inflow, 3 numbers.
Again, we are not, I'm not in the business of giving forward numbers. But what I can clearly say that you will see similar growth trajectory being maintained going forward, definitely. And that is because of, it'll be led by I think the inorganic growth, the new businesses which we are adding, that will be a sizable contributor. And similarly, in terms of margins, because now with the wheel business being added, there's a lot of backward integration. The baking business will start contributing towards the margin. So you will see both growth in terms of margins as well as in terms of numbers.
Ms. Loya, good morning. Prashant here. I understand you don't want to put down numbers, but you said you could expect similar kind of growth. 24 revenues went up. Of course, it was a big phenomenal year, 75%.
You will see a substantial growth which will happen going forward. And it's very visible. The order books are strong. Execution is improving. A lot of the inorganic growth the company is set to, take off in terms of the verticals which we have added. So, and in terms of the economy, we are not seeing any headwinds.
Got it. Ms. Loya, could you two things? One, earlier this year received a large order from the railways, right? You said you're expecting more orders to come through post-June. If you can give us a sense of what will be put out as tenders, in your experience. Given what we've already seen earlier this year. And the second, what is the capacity right now per month, wagon capacity?
So we are right now doing close to about anything between 800 to 900 wagons we are executing per month. Idea is that this year we are going to ramp it up to about 1,000 wagons. And we are now adding a lot of specialized wagons, which are going to again contribute sizably towards our margins. So the kind of wagons today which we are manufacturing, none of our peers are doing in the industry. And these are wagons which are going to be the drivers going forward. So our idea is to add a lot of, technology in terms of our product mix.
Earlier, you had planned to launch an EV as well. You said you would launch it by the month of April. What's the latest on that?
Okay. No, so I had said the certification would be completed and we are on track. We are expecting the certification any day. And the launch was around July, which we had said, and that also we are completely on track.
Okay, so you launch the EV by July, is what you're saying?
Yes, yes.
Oh, and in which category will it be?
It'll be a commercial vehicle. It'll be in the 1-ton payload category, and that is where our focus is on the last mile. And we are looking to within the next 2 years, we are going to be launching incrementally new products between the 1-ton and the 3-ton category.
Okay, so will it largely be for the domestic market, or would you also be looking at exports? And overall, exports as a percentage of sales, how much is it now? How much do you plan to grow it by?
Okay. So EV, initially the focus is going to be the domestic market because, the capacity which we have and the kind of demand which we are seeing, I think the domestic market itself would meet all our capacities. In terms of exports, today, as a percentage, it's not substantial. But going forward, the braking business is going to contribute sizably towards the export business. And the wheel business which we have acquired, it will take us about 12 to 18 months to do the kind of backward integration which we have emphasized. Post that, you will see substantial exports happening to Europe because we already have the right technology in place and we have a very strong partner who is looking to buy wheel sets from India.
Okay, all right. Since you've spoken about this inorganic growth that you talked about, you acquired Bonatrans India for around 271 crores. That's going to help you all with regard to exports, right? Tell us, what is the revenue out there? What is the current revenue? How do you see that scaling up at optimal levels? What kind of revenues can this acquired business do?
So currently, the revenues are small because they were focused mainly on the metro segment as well as the Vande Bharat. So the good thing is that the company has all the certifications. We are already supplying for the Vande Bharat, for the passenger business in India, as well as globally we are already supplying. So we have the necessary certifications. This year we are looking at revenues of anything between 300 to 400 crores in that business. But as and when the backward integration happens, this year we are looking at to manufacture close to about 200,000 wheel sets. So you're looking at revenues of plus 2,000 to 3,000 crores. And, and with at least 40 to 50% of that will be exported.
Let me just get those numbers out of the way. From this acquired asset in the near term, that's for this year, you'll do 3 to 400 crores, right?
Yes.
And ultimately, you can scale it up to 2,000 crores.
Anything between 2 to 3,000 crores.
By when?
It takes typically these kind of expansions take at least 18 to 24 months is the target which we have in mind.
So by FY27, you'll do more than 2,000 crores from this acquired asset itself.
Yes.
And how much more money will you have to invest? Because this is going to be the big trigger in terms of revenue growth going ahead. Will you have to put some more capital in besides this 270 crores that you're paid?
Yeah, definitely. This requires substantial investments. We are looking at upward of 1,000 odd crores of investments. And even our partners they are going to be also chipping in, because for them also to secure their businesses in Europe, it is very important. As you're aware that, Europe today is struggling because of the Russia-Ukraine crisis which has happened, and most of the wheel sets, especially in the freight business in Europe, used to come from Ukraine and Russia. So they are looking at an alternative supply base.
Okay. Can you tell us what would be the share of private sector wagons in your incremental order inflow?
The private sector wagon will continue to play a substantial role. So as we are increasing our capacity, I think, if you look at our order book today, it's more than 40% of our order books is private. And I think that trend will continue to remain there. And as I mentioned, in this financial year and going forward, you will see us producing more and more of specialized wagons with much higher margins, which none of our peers are doing right now.
So you said 40%, it will continue to be 40% of your orders from the private sector, right? And I didn't get the number. Overall, what kind of order inflows are you expecting by the end of FY25 and FY26 in terms of both wagons, the amount of wagons and the absolute term orders?
So currently our order book stands at about 7,000 crore plus. So I think idea is to continue to maintain these kind of order books, because you have to realize the execution is also going to go up quarter on quarter. And if you add too much of order book and not execute, then you are getting into late delivery penalties. So we are very circumspect when we add additional orders. But the incremental orders which are going to come from the other verticals. You will see a lot of orders coming on the wheel business, on the braking business, on the CV business. So that's where you're going to see other order books coming in.
Got that. So, I think the headline, of course, is that number that you gave, right? 2,000 to 3,000 crores from that Bonatrans India Private Limited. They make wheel sets. But that's in a few years, at least 2-3 years, right? And that will require...
But year on year, you're now going to see incremental revenues coming in. And this will play a substantial role in our business itself, because Wheelsex today is about 30% of our overall cost of a wagon. So there you will see now that becoming in-house, and we are the only players who have this capacity. So you will start seeing incremental EBITDA margins coming in.
All right. Ms. Loya, great to speak with you. Thank you very much. We wish you all the best and good luck. Speak to you soon again. So that is the management of the Jupiter Wagons with some perspective on the numbers. The market had staged a nice, decent recovery. It's still off the lows, but we're down about 55 points as things stand right now. I mean, the big movers in the last 1 hour or so are REC and PFC, which are up 4.5%, 5%. Abhishek outlined what the management said in that call. And I mean, I think one should also make a quick mention of IGL, which is now up 6%. So that is, a very sharp move, which has continued after the opening. So it's kind of kept on moving higher. The next company on our radar is Chambal Fertilizer. The company reported a mixed set of numbers in the fourth quarter. EBITDA and net profits expanded, but revenues declined by 26% on a year-on-year basis. The management has said that they've a strong pipeline of 12 new products in FY25. So let's get some sense of what FY25 will look like. We've got Mr. Abhay Baijal, Managing Director at the company, joining us now. Mr. Baijal, good morning. Good to have you with us here. Thank you very much for your time. Prashant this side. If I can start by asking you, you saw low urea volumes in the fourth quarter, and there were some planned maintenance shutdowns, which I think took a bite out of what you could have otherwise done. Could you tell us what kind of volume growth on the urea side can we expect in FY25? And will you more than make up for what you lost during Q4?
So, Prashant, you're right that we had two major shutdowns to do a plant maintenance. That was for our plants, number one and number two. These volumes will be made up subsequently in the next year, obviously, once the plants start running. And the growth will be, we are running these plants more or less flat out. So unless we do some more capacity additions or debottlenecking, we will not be able to produce very much more. But what we are looking at is margin expansion through energy efficiency projects that we have already completed. So that will be the key driver for growth in terms of EBITDA next year.
What kind of numbers should we expect, sir? I mean, if you want to guide them.
I would like to name a number because the business depends on three factors, which is the gas price, the dollar, and the number. These kind of numbers we can't really predict going forward. And these plants, of course, what we have planned to do, we have done better than that, what the initial results show us. So we would be, we have spent almost 185 crores on this energy efficiency projects. And we expect good returns out of that. You can take it that normally we do projects between 4 to 5 years payback. You can make your guess accordingly.
So I'll come back to your overall business, but I just want to talk a little bit about the balance sheet, Mr. Baijal, because you are sitting on a debt of almost 1,400 crores now. With the TAN project going ahead, can we assume that your debt will go up further? If yes, what is the maximum debt level that you're comfortable with, say, by the end of FY25?
Like Sonal, I think this company is known for very strong cash flows. And going forward, we are actually also sitting on quite a bit of cash as of 31st March. Quite a bit of that will be settled against the loans. We expect to be a very, very low debt company towards the end of 2025. And
when you say low debt, can you just quantify it for us?
I would say that it will be close to zero. And the second part is that in terms of TAN, I don't think we have planned any borrowings for TAN.
No, close to zero. I mean, you're sitting on debt of 1,400 crores, right? So you're saying by the end of FY25,
we have cash also.
Retire?
We have cash on the books.
Yeah. Okay. Right. So by the end of FY25, you're saying you'll be close to zero debt. Okay, got it.
Mr.
And
Baijal, yeah, okay, go ahead. No, so Mr. Baijal, the number I think that we have is you're already a net cash company, and you're saying that even though you have this TAN project, you'll continue to remain net cash. Did we get that correct? Because as of now, you're around 200 crores net cash.
Yes.
Right. Okay, got that out of the way. Now, what about the subsidy? You received around, I think, 15,000 odd crores in the past year. That was a little bit lower due to lower gas prices. Is there any subsidy that's outstanding?
No, in fact, we are quite happy with the situation of the subsidy right now. And I think with the government making adequate allocations, we don't see any problem on that going forward.
Okay.
Sorry, you're saying, Mr. Vedal, you're saying that no problem in receiving subsidies, etc.
Yes. I mean, there's no shortfall on the government side allocations.
Of course. You know, there has been a revision in gas costs recently. Could you tell us, what do you expect? You said that's one of the three variables which impacts the business quite a bit. In your opinion, I mean, how's that going to largely going to pan out in 525?
As per the policy, there are two parts to the compensation that we get. One is up to a certain assessed capacity, and then thereafter. The part which is thereafter is the one that is impacted by gas prices as well as the international import prices. So that's the part with lowering gas prices, you get a better margin there. On the other side, at the same time, because of energy efficiency projects, whatever costs you can control, your energy efficiency paybacks get better if gas prices go up. So it's a kind of a mixed bag. And you have to see where the optimum operating conditions lie.
You know, if international gas prices, as many are forecasting, come under, fall quite a bit because of this anticipated gas glut. What is the sensitivity to your earnings based on that second part? I mean, if gas prices come off quite a bit, could you give us a sense?
I would say that in terms of dollars per ton, we would be varying by between $2 to $3 per ton on every plus and minus that happens, because on the beyond 100% production we will gain. On the other side, on the efficiency cost improvement, we don't get that much payback. So it is netted off. If you net it off, that is almost $3 to $4 a ton.
$3 to $4 a
ton.
A ton of produce.
Of the product.
Product. Okay, got that. I mean, that's quite a bit, right? I mean, that's... Okay, got that. Thank you very much. Let's hope, gas costs come off, not just for you, but I guess it'll be good for... Sorry.
If it goes down too much, then also there's a problem. If it goes up too much, also beyond there's a problem. So there's a netting off.
Yeah.
And it can be plus and minus both ways. Yeah.
Got that. But I think as an importer, it'll be net positive for the country. Thank you very much, sir. Appreciate you joining in and running us through all of that detail. Well, I think, taking stock of the market, we are, it's come up, 35 points now. That's it. So 22,267 is where we are at. And it's a decent kind of recovery. And it's come from that 22,185-ish kind of levels, which is around 22,200, which Mitesh was also talking about. Mitesh, so that bounce is here. Can we build on it? Your sense?
Prashant, I think the first step, that the level should be respected is happening. Now, we still haven't got a reversal pattern, but I think this bounce could still try and hit 22,320 and in a good case scenario, 22,400. So we're still positive. I think, we did recommend some of our clients to take longs at lower levels. But yeah, you have to be slightly nimble because this is not still an uptrending market. This is a bounce within the sideways choppy market. So I think, 22,320 and 22,400 are the two targets which I have penciled in for this bounce back. And coming to individual stocks, I have a buy on HAL. After a few days of correction, the stock is at support area. So buy here with a stop at 37.30 for targets of 38.45. And a sell on Pidilite. Some negative candlestick pattern with volumes is happening here. So this could see more decline. So Pidilite is a sell. Keep a stop at 28.50. Look for targets of around 27.35.
Okay, it's interesting. Pidilite, despite decent numbers, volume growth of almost 13%, the stock is down in trade. So clearly this market is in a mood of taking profits despite decent earnings. Let's slip into a quick break. On the other side, we'll focus on all of these stocks that are moving on the back of news updates. Stay tuned. Well, Voltas is a stock on our radar. Vamakshi is here to tell us about the numbers and the stock move as well. Vamakshi, over to you.
Well, absolutely, Sonia. The stock is taking a knock in the trading session today, and that is because the company posted a weak set of numbers in the fourth quarter. Revenue was definitely a beat, came in nearly 10% higher than what we were expecting, but thereon, the EBITDA was a miss. It was nearly 34% lower than what we were expecting, and the net profit was a 52% miss. Let me quickly take you through the numbers. Revenue saw an uptick of almost 42.1%, and this was largely being led by their UCP, that is the unitary cooling products, which grew by almost 44%, and even EMP, which is the electromechanical projects, that also saw good growth of almost 47% on a year-on-year basis. But when we look at the margins, they've contracted sharply, 284 basis points lower on a year-on-year basis, now coming in at 4.5%, and this was largely led by the losses that the company generated from the EMP business. They remained elevated, and that is mainly on account of the provisioning in the international business. The street was expecting the losses in this business to narrow, however, that has not transpired. Apart from that, the EBIT margin of the UCP business was also expected to improve, but again, over here, the UCP business margins have actually declined by almost 90 basis points on a year-on-year basis, so therefore leading to a miss as far as the margins are concerned. EBITDA also saw a downtick of almost 12.6%, and the net profit declined by almost 22% on a year-on-year basis. Apart from that, the key negatives this time around were the loss in market share. It's a marginal loss. The market share for the company in the RAC segment has declined to 18.7% as compared to 19% seen in December 2023. The international project business also continues to face headwinds, is what the company has highlighted. So overall, a weak set of numbers coming in for the counter, and as a result, the stock is declining in the trading session today.
Okay, all right. That stock getting knocked back in today's trade. Thanks a lot for that, Vamakshi. The other one that's pulling back in the biggest loose on the Nifty is Dr. Reddy's. Ekta joins us to fill us in with more details. Ekta?
Thanks for that. Well, yes, for Dr. Reddy's, it's under pressure. The revenue was down on a reported basis, or rather up by around 12.5%. But versus expectations, it was up around, it was lower than expectations of growth of around 17%. But on an adjusted basis, it did come in line with expectations. Now, EBITDA was where the disappointment was. The margins came in at around 26.4%. The street was anticipating 27 to 28% this quarter. The other key disappointment was the US business. The US revenue came in at $391 million. The street was anticipating around $400 million in terms of sales, and $391 million, in fact, came in lower than expected. Besides lower than expectations, it was a sequential decline, considering they did $403 million in the previous quarter. India, adjusted for divestment of non-core business, was okay. It was up 11%. They're expecting double-digit growth to continue. Russia declined because of the currency woes there, but nonetheless, there was still a decline in the Russian market. So I think the street didn't like that. Guidance from the management. They've guided for the margins to remain around the 25% range. They're expecting the rest of the world markets to grow in double digits. They aim for 20+ launches of products in the US. They're aiming to grow the domestic business at around 10% for FY25, X of the Nestle JV, which they seem to be quite bullish on. And they've also received a voluntary action indicated for their Bachupalli formulation facility, which was a little bit of an overhang. So that too has been out of the way. Now, brokerages are a bit sanguine on it. CLSA has an underperform. They believe there is a midterm outlook which is subdued, which is led by US price erosion, dependency on Revlimid generic, high acute mix in India. Jefferies has an underperform. They believe the EBITDA margins for FY25 should probably remain under pressure. Nomura has a neutral. They believe Q4 was a strong quarter.
Okay, thanks a lot, Ekta, for that. Let's slip into a quick break. On the other side of the break, we'll connect with Rishi Anand, who's the MD and CEO of Adhar Housing Finance. The 3,000 crore rupee IPO opens for subscription today. So we'll find out more about that business in a bit.
Welcome back. The secondary markets are doing fine with a nice bounce, 35 points. Lower is all that there is now, 22,266. We've got the primary market action, which was also, of course, been hot. Bangalore-based housing finance company, Adhar Housing, their IPO is opening today. It's a company which is focused and lends to the lower end of the economic strata of the population. And the issue for 3,000 crores, they want to raise 3,000 crores, starts today. The anchor book, of course, was done yesterday, and they raised about 900 crores from there. We have Mr. Rishi Anand, Managing Director and CEO of the company, joining us here in the studios to take some questions. Rishi, great to have you with us here.
Thank you so much. Very good morning
At the outset, let me wish you all the best of luck.
Thank you so much. Much needed.
We were just chatting, right? 2010 you kicked off.
That's right.
And you, in 2024, now as we speak, you're at about, what, 18, 19,000
We are about 20,000 crores of AUM.
AUM.
That's right.
And you've grown at a CAGR of over 20%.
Over 20%. Over 20%. In the last 3 years, over 20%.
Is that the rate of growth that one should expect, investors, viewers who are watching, that one should expect going forward as well?
I would say at the size that we are, 20,000 crores, and the segment that we deal with, 20% is quite a reasonable number.
Okay, 20% growth is a reasonable number. Rishi, good morning and thanks
Good
for
morning.
joining in.
Thank you so much.
So 60% of your loans go to salaried class, 40% to non-salaried. Tell us a little bit about what the demand trends are looking like right now. What are the challenges that you're facing? Because, affordable housing, the segment has seen a bit of a slowdown in the last couple of weeks and months.
So when we talk about, the segment, we'll have to first relate to what is the segment that we fund to. We typically fund to the lower strata of the society, which is the low income housing segment. We typically call them as economically weaker section and lower income group. That's the segment we cater to. And then there is this question around, how come salaried in this segment? So when we deal with salaried, I can, throw a few examples here. So we fund to people who are government salaried employees, class 4 employees of Government of India, police jawans, army jawans, drivers, maids. So these are our customers. Is this segment challenging, as you asked? I would say no, because there is more than enough demand in this segment. And if I were to quote a report by RBI in 2019, the total housing unit shortfall in the country stands at about 10 crores, out of which 9.5 crore comes from the EWS LIG segment that I cater to. So there is more than enough demand to cater to.
Okay. All right. Thanks a lot, sir, for coming down. Well, a couple of quick questions then. You have an OFS as well as you're going to be raising primary market as well. So 1,000 crores comes back to the company. How does it change your tier 1 ratio? If you could help us out with that. And I'm also looking at the breakup. The non-home loans, that's gone up, I think, from around 15% to around 24%.
That's right.
As a percentage of the mix, how does it change? So on both these two.
So at the AUM level, at the company level, in terms of the portfolio mix, we are today 23% non-home loans. And when we say non-home loans in our kind of business, the kind of segment that we cater to, these are micro loan against property with an average ticket size of about 8 lakhs. And on the home loan side, our average ticket size stands at about 11, 12 lakhs incremental. On the book, the ticket size stands at 10 lakh rupees. So when we say loan against property, it is not the MSME loan against high ticket loans. These are very small micro loans. And the way the management looks at it, at any given point in time, we will be in the range of about 75-25 home loan to non-home loan ratio.
Got it. And how does it change your tier 1 ratio since your 1,000 crores will be coming back into the company?
So today, in terms of tier 1, we stand at 39%. And we should be hovering around. So we will see for example, if I were to look at the ROE ratio, how will they move? The moment the primary comes in, the ROE ratio, which is at about 18.4%, should drop to about 17%, and it will take a couple of years to be back into about 18.4%.
Rishi, another housing finance company I was talking to is telling me that, the journey from zero to about 12, 13, 14,000 crores, 15,000 crores, I mean, that's like it's not a, you get there fast, and then after that it becomes a little, because the size becomes bigger after 15. You're at 20. I mean, just wanted to address
that. So we've been pondering around this question when we were less than 15,000 crores, and we were asked these questions: would anybody cross 15,000 crores in the segment we cater to? We crossed that 15 crore mark. Then the question was, will we reach 20,000 crores? As we speak today, we are already 20,000 crores. And I would go back and relate it to the demand. There is more than sufficient demand, so why not? We are the largest by far in the segment that we deal with, and we are a monoline company. We have no other product lines, and we would want to continue to grow in this segment.
Is enough housing stock being built on that side? I mean, that's again a feedback one has heard. That is largely now everyone wants to move up the price curve. I mean,
housing stock built also relates to, again, I'll come back to the segment. What is my customer buying? What is he doing with the money that I give him? So 40% of my portfolio stands at an individual buying a ready-built property from a second individual. So it's called resale in our parlance. And about 35-40% of my customer is doing self-construction. He owns a plot, he wants to do construction on it. So whether a new housing is get created or not does not matter too much. What my customer is buying is available in the
So we're not
market.
talking about typical apartment. I mean, that's not the
developer-led construction.
The developer-led. That's
so
not
it is not prevalent in the segment that we
that
deal
you're
with. It is
operating
more
in.
of individual resale.
Okay. I'll come to that in a bit. You were telling Nigel that with the fundraise of 1,000 crores, we were discussing a tier 1 ratio. What would your tier 1 ratio be post that?
Sajay, what would it be? Let me come back to that question once
Okay,
again.
okay, we'll come back to you in a bit. I want to know what is the affordable segment growth rate for the industry that you're expecting. I'm asking because, we are seeing some signs of trouble, right? Whether it is a job situation is not that great, cost of living has gone up, inflation is hitting a lot of people. So in this lower strata, do you think the affordable housing segment may not grow as fast as what it did in the last couple of years?
In fact, I would want to put it the other way around. With our experience of 15 years with the segment that we're talking about, it is more volatile and more flexible segment. And I would maybe take you back to the COVID times and post-COVID times. What actually happened is this segment of the society were the first ones to come back to the jobs. They were the first ones to, and when I say volatile, today one of my customers, let's say, is a salaried customer. Tomorrow morning he goes and opens a shop. So very volatile, very flexible customer segment. We have not seen any degrowth in the segment in the last 3 to 4 years, post-COVID at least.
Okay, all right. So we'll wait for you to come back on the tier 1 ratio, how things change out there. But I think one thing that's supporting you is the valuation-wise, it has some comfort in comparison to the listed peers, and that chart should come up for our viewers on the screen. Final question, sir, before we let you go. The NIMs have been improving, and as you mentioned, the non-home loans as well, that part of the business has been moving up.
Right.
Do you have further, levers in place to see it open? Because if we pull up a chart, the NIMs have improved nicely over the last few years.
That's right. So NIMs today close are upward of 8.5%, close to about 9%. The way NIMs work is, we typically at the organization level, we work on something called spreads, and the spreads are topped up by treasury income. So what we follow is spreads. We have been at a healthy spread of anywhere between upward of 5.5% to 6%, which is a major contributor to the NIMs. The management feels that we will be able to sustain these kind of spreads as we move ahead in the business.
Well, we wish you well, sir. Appreciate you joining in and giving
Thank you
us
so much.
fair insights on the business. We look forward to the listing, and on that, maybe in fact we'll press you for a few more numbers as
Thank
well.
you so much.
And all the best with the listing. Thank you for being with us
Good
here.
day. Thank you. Bye-bye.
Okay. With that, it is a wrap on Bazaar. Thanks a lot for watching. The Chart Busters will come up next.
Dr. Reddy's stock slumping in today's trading session. The top Nifty loser after its fourth quarter numbers missed street expectations. Margins contract sequentially while US and Russia businesses disappoint. Managements tell CNBC-TV18 that the margin was higher by expenses and they expect the India business to grow in double digits going ahead.
Voltas loses in trade on the back of a weak showing in the fourth quarter. The EBITDA and the margins miss estimates while cooling products market share declines as well. The stock is down 7%.
IGL gains after the fourth quarter numbers meet expectations. Revenue rises 1.2% sequentially while volume is at a multi-quarter high.
Pidilite as well is down in trade as EBITDA misses estimates due to higher branding expenses. Brokerage, Citi issues a sell call with a target price of 2,200 rupees a share.
REC recovers from a two-day losing streak after the management clarifies that the RBI's draft guidelines on project financing